Everybody.
So, welcome everyone. We've got to thank Fabio for being here during busy tax season. So, we're going to talk about some everyone's favorite topic, taxes for 2024, and what we need to be doing. And I think a more important long-term conversation about estate planning that I'm starting to learn about and get more comfortable with. Even though I have some of the pieces already in place, the whole estate planning conversation is new to me. So, Fabio's been helping me understand it a lot better. And I think it's a conversation for everyone here. So with that being said, I'll let Fabio take over. Maybe just introduce yourself briefly and you can jump into it.
Okay, perfect. So I got the boring lecture that's all prepped out. And then obviously, instead of like feeling like you're at school, rewinding back to those days, if you guys have a question, pop it into the chat and I'll let Paul and Josh moderate this, and then they can let me know if they want me to stop to answer, since it's their presentation really. But essentially what we're going to do today, we're going to cover some tax and estate planning tips for real estate investors. I'm trying to keep this as relevant to real estate investors as possible. All right. So, sometimes I've done many of these for Rockstar at large and for other organizations. And I really want to make sure that we stay relevant to the overall theme of real estate investors and the problems that real estate investors encounter, rather than addressing individual situations, if you guys don't mind. Okay.
Yep.
Without further ado, I'm going to give you guys a quick intro. We are then going to get into the very, very basics of estate planning. I'm then going to go on to the super popular question, how or should I use a corporation? And we're going to look at two areas of taxation in terms of expenditures and transactions that we are starting to see more CRA action in terms of audit and double checking. Okay. And then obviously, if we have time, I'm going to open the field to questions. You guys can ask me about anything from estate planning to traditional investing to real estate investing to general taxation, whatever you want. Okay. So who are we, or who am I? We're the Campanile Group. We are an integrated tax and financial planning firm. Specifically, we deal with let's call them high net worth families or high income earning families and entrepreneurs. And what makes us a little bit different is we integrate tax planning, tax compliance with investment advisory and estate planning and life insurance. So it's a full-blown accounting firm, traditional accounting firm, along with a full-blown financial planning firm. And it's all under one roof. These are the three senior players at the firm. Myself, I head tax and financial planning. I've been a tax and financial planning specialist since 2002 now. My wife, Lisa Marie, which is now Lisa Marie Campanella, not Lisa Marie Franzone. She's a CPA. She heads the tax compliance department or the general accounting department. And Nick Lenaro does all the assistance with underwriting and applications for life insurance. And I need you guys, seriously, I need you guys to do me a favor. Okay, because I started a YouTube channel and I'm starting a monthly financial tips newsletter. If you don't mind, sign up for both. All right, because my wife thinks that nobody's going to sign up for my YouTube channel, and she's right, because I got like 40 subscribers, and I think that like half of them are just bots. So do me a favor, guys. Do me a solid. All right, if you like this. If you don't like this, then don't do anything. Okay. So let's get going with the curriculum. So what the heck is estate planning? All right. And people always have this question. Paul had this question when I came to his place and he interviewed me. And it's not something that people really think about until it's time to think about it. But the problem with estate planning is that when it's time to think about it, you're on your freaking deathbed and it's kind of too late to really be doing anything. Okay. So estate planning it's essentially a process. That's all it is. It's a process. And it is the final step in a complete financial plan. All right. And it's the planning for the ultimate distribution of your assets when you either become incapacitated, either mentally or physically, or when you die. That's essentially what the definition of estate planning is. So why is it important? Okay, let me ask you guys a couple of questions, right? Do you have kids, or do you have people that you care about? Or do you maybe have a charity or a church or a religious organization that you care about? All right. Do you care about what happens to your assets when you cannot manage them? And do you care about who makes decisions for you when you're not capable of making decisions for yourself? If you answered yes to any of these questions, then estate planning is actually very important to you, because that's what estate planning deals with. It deals with your assets, what happens to your assets when you can't make those decisions for yourself anymore. Maybe you get Alzheimer's, or you get into a really bad car accident and you're on a ventilator. Who's going to make the decisions for you, and how should they be making those decisions, right? And then when you die, who is going to be getting your stuff, and how should that stuff be distributed? Essentially, that is estate planning. So what are the fundamental problems when it comes to your estate or estate planning, right? So how are your assets going to be controlled and distributed? How is tax going to be handled? And are you going to have liquidity issues with your estate? And are you going to be able to equalize your estate? AKA, if you have 4 kids, are they going to get things equally? Or do you not want them to get things equally, etc.? Those are the issues with estate planning. Okay. So how are the assets to be controlled and dispersed? This is primarily a legal function, and it's a function of a POA, or a power of attorney, and a will, right? For those of you that don't know the difference between the two, the power of attorney essentially gives somebody else decision-making authority on either financial matters, health matters, so on and so forth. The will is what dictates the disbursement of your assets when you pass away. Right? There's another area that is very important to estate planning. That's trusts. But in all honesty, that's a very advanced subject, and it's kind of beyond the scope of what I can talk about in, let's say, half an hour to an hour, right? But in essence, the basics of estate planning, everybody should have their wishes captured in a power of attorney and a will. That's for sure. Okay, so let's take a look at the tax problem. All right. And I always give this specific example because it uses real numbers and it kind of hits home for real estate investors. So your estate is going to be subject to tax at your death, right? If you are married, all right, there's a rollover, an automatic rollover on the first death if you leave everything to your spouse. So there's no tax on the first death of a married couple. However, on the second death, you are taxed. Your estate is taxed in full, all right? And what happens here is the way that you are taxed is you are deemed, and you'll hear this word often in taxation, you are deemed, meaning that the law says you have sold everything that you own, all right? Whether you've sold it or not, it doesn't matter. You are deemed to have sold all of your assets at fair market value. So let's take a look at a real life example. So if you purchased a single family home in 1985 in Toronto, that would have cost you a whopping $109,000. If you just maintained it, whatever, didn't really do much to it, the value of that same home, if you died in 2022, January 2022, would have been about $1.35 million. Therefore, you have an increase in value. The increase in value is about $1.2 million. All right. That $1.2 million is what will be the triggered fair market value of the disposition of this property on your final tax return. Meaning that you will have to add half of that gain, or $618,000, to your taxable income in one shot. If we look at the highest federal Ontario combined marginal tax rate, which is what you're going to pay in this case, because you're going to be definitely at the highest marginal rate, you're looking at 53.53% in tax. Keeping in mind, this is a simplistic situation. You don't even have recapture. You haven't depreciated anything here, okay? Therefore, you're going to have taxes owing of over $330,000, so about $331,000. Then to add insult to injury, the government of Ontario, for issuing letters of probate, or for what do they call it now, for appointing the trustee, they're going to ask you for another $20,000. So in total, you're going to be handing $351,000 to the government. This always comes as a surprise to people who have not done any estate planning. All right. I can't tell you, at least once a year, one of my clients will come to me. They'll say, hey, my mom passed away, my uncle passed away, my dad passed away. They had some RRSPs, touch of money in the bank, and we inherited the cottage, the house, and their rental property. Then I calculate this for them, and their jaws drop. They're like, where am I going to get the money for this? Okay. So that's the fundamental, a super simplified version of the overall tax burden that you're going to be dealing with at the estate level. So all your rental properties deemed to be disposed of, all of your RRSPs disposed of, all of your taxable assets all disposed of. So then we have the estate liquidity problem. So who's going to pay that tax, right? What if you have 3 children, but only 2 rental properties? How are you going to deal with that issue? What if one of the children wants the rental properties, but the other child wants cash? How are you going to deal with that problem? So you have a liquidity issue, and you have a need for immediate cash, which is going to be an issue. Or you have a need to disperse the properties. Let's say you have 2 children and 2 rental properties. One of those rental properties is worth double the other, and the children don't get along. Well, if they don't get along, you don't want to screw them for life and make them jointly in control of both of those properties, right? How are you going to equalize the estate? So the estate liquidity issue is a huge issue that a lot of people run into when they pass away, especially if they haven't done any planning. All right. So we've covered the basics of the problem, and I'm going to give you guys sort of a basic solution. All right. So now I do want to stop because I have Paul asked a question, and if you guys have any questions with what I've covered up to this point, go ahead and ask. Okay. So Paul asked, how is the marginal tax rate calculated at death? It's calculated in the exact same manner as if you were alive. You take your taxable income, you calculate your taxable income, and apply it to the various different marginal tax rates.
Okay? So that gain we made on the deemed disposition.
Yeah, on the deemed disposition. Sorry, you cut out there, Paul.
Yikes. Sorry, I'm saying that the deemed disposition, that income, that's I guess it's not a capital gain then, it's just regular income.
Sorry, it's a capital gain, but the gain was $1.2 million. So I cut it in half to 618 grand.
Oh, okay.
So it's a capital gain. It's a capital gain.
Like a capital gain. I get it.
Well, but it is a capital gain.
I get it.
Right.
But
the issue is,
and because of the size of the gain, that's where you're getting the highest taxable margin.
Generally speaking, it's not going to be one asset, right? That these people have. They're going to have 3-4 properties for the most part. So I'm just isolating one asset in this family's estate, and I'm throwing it into the mix to show you the maximum amount of pain that you can suffer.
Okay, fair enough.
All right, perfect. right? So I have, and I teach this at Rockstar's life insurance course. I pulled it out there because it's a common problem that we run into, that we sometimes utilize life insurance for. Okay, so in this particular case study, once again, this is super simplified, right? But in this particular case study, we've got mom and dad. They're both 60. They're in good health and they're non-smokers. They recently sold a, let's call it a problem rental property, right? And everybody who's, invested in properties over any period of time is always going to run into one of these problem properties that they just can't seem to find a good tenant in. Everything keeps going wrong with it. And they say, forget it, we're going to sell it. Okay. So they're left with a bunch of cash, after-tax cash. They want to pass their cottage, which is another property that they own, to their children free of debt. They don't want their children to worry about paying the eventual tax bill on the disposition of the cottage. And let's say imagine we've dealt with the other assets using an estate freeze or some other means. Okay, we're going to isolate it to this one asset. Okay. All right. Oops. Sorry. Okay. So what do we got here? What's our problem? So the cottage price, let's say when they bought it, was 560 grand. Okay. I'm just making numbers up. Number of years to the estimated second death is 25 years. Okay. Remember, it's the second death that triggers the tax. Let's say this property grows at 4% per year. It's going to be about 1.5 million by the time they hit their second death. We're going to get just under $1 million of income. Only half of that is taxable. The tax rate is 53.53%. Therefore, we have estimated tax at second death of $250,000, right? So the couple wants a guaranteed solution to pay the tax bill. They want zero chance of loss. And they're worried about tax as they are projected to be in a high tax bracket because they have other assets, okay? So what do? In this particular case, in a similar case, many years ago, we used something called a universal life insurance contract, which is, if you know me, if you've been following me, or if you've come to any of my seminars, I very, very rarely use universal life insurance. I primarily use whole life insurance. But in this simplistic situation where they're confident in the exact amount of tax that they're going to owe, universal life solves the problem better than whole life. Okay. So a universal life insurance policy has a guaranteed premium. It doesn't change. Has a guaranteed payout that doesn't change. There's 0% chance of any loss. There's zero taxes involved. It's really easy to understand. And if you want to, you can over-contribute to the policy and into almost like a TFSA account. All right. So in this particular case, if you remember, we calculated that we estimate there's going to be $250,000 of tax owing in 25 years or so. So they bought the policy, which was joint last to die, which triggers the death benefit on the second death. So either mom or dad, whoever, grandma or grandpa, whoever dies first. All right. They pay an annual premium at the time. It was just under $4,000 a year, 25 times. That's $94,000 over a 25-year period, right? And they're guaranteed to get $250,000, right? So when we calculated the ROI on this, it made a lot of sense to them. Why? They had a lot of rental properties, RRSP income coming in, a pension coming in. They were actually in quite a high tax bracket, like about 50%. So they were getting a guaranteed rate of return of about just over 7%. If all plays out, they die in 25 years, okay? Which would be a taxable equivalent return of 16%. You're not going to find that in the GIC or money markets, okay? It's just impossible to find that kind of a rate of return. So in this particular case, they had the money. It didn't break the bank. It gave them some flexibility. They went ahead with this particular product, and it was timed perfectly. As soon as they needed the money to pass the cottage on to the kids, they're going to have the money. All right. Simple solution. And this is, guys, this is really, really a dumbed down version of all this. Okay.
Let me
Go ahead. I'm going to answer Gino and Manjeet after.
It's obvious, but I just want to make sure.
Yeah.
Yeah. I think you're calculating this return, and this is for anybody who's confused, this way. Like there's a total payment of 94,000, but you're getting back 250,000, right? And the return you're calculating is based on kind of the difference there. Is that correct?
No. I'm actually doing like a net present value almost. So I'm just, you could do it in on either a financial calculator or in Excel. Probably Excel is the easiest because everybody's got one, but you do equals rate, open bracket, and then boom, boom, boom. So it's what is the compound interest rate? Essentially, what is the GIC that you would have to buy that would give you the equivalent of 25 contributions of $3,761 with an ending amount of $250,000. You would need, it's called the geometric return or the geometric
Okay.
Right. It's not that hard, but it's what magical GIC would you have to buy to get 250 with 25 payments of 3,761? Make sense?
Yeah, I got it. I got what you're saying. My simple brain is going, well, if I'm paying out 94 and I'm getting 250 back,
yeah,
I'm sort of making $156,000.
Yeah. Exactly. But if you were to pay 94 out right away and get 250 back in 25 years, your rate of return would be actually much lower. Than this, because it's
spread out.
You got it. Okay. So I have a couple of other questions here that I'm going to answer before I get to the next section. Okay. Gino asks, is the principal home subject to the same tax burden as the property investment? No, you get the principal residence exemption. So you trigger the gain, but you claim the principal residence exemption against it, so you pay no tax. Okay. Manjeet, do you take care of Henson Trust and will you be discussing it? No, I won't be discussing Henson Trust. Way too advanced for this. If anyone's asking, a Henson Trust is a trust that you leave to a disabled child, because in order to get their disability benefits from Ontario, they're not allowed to own any assets, so we put them in trust. No, it's way too advanced for this. Victor asks, how is the 7.35 being calculated? It's the rate of return on an equivalent, let's call it GIC. Oh, Victor, you understood. Perfect. Okay. All right. So I found nobody's got any more questions there. I kind of want to move from the estate planning side over to the the corporation side. And there are some more estate planning issues addressed in the corporation side. Okay. So let's take a look at corporations. Well, what about a corporation? And I got to be honest with you guys, this is the most annoying and most frequent question I get, especially from real estate investors. Okay. And I want to emphasize this. There are no annual tax benefits to having a corporation year to year. Okay. There are tax benefits and tax strategies I implement for self-employed incorporated individuals who are high income earning 100%. I myself have a number of this office you're looking at, I own it through a corporation. I have condo in a corporation. I have a number of properties in a corporation, but all things equal, a regular family is going to get no immediate tax benefits from a corporation. And in fact, if you are a high income earning individual paying tax at the highest rate, the integration is not perfect. You're actually paying more tax if you have a corporation. Okay. The Canadian taxation system has an integration concept, which not all countries have. And what does that mean? The rules and the tax rates are designed in such a manner that plus or minus a couple of percentage points, you should be indifferent with where you hold your assets in a corporation, in a partnership, in a trust, or personally. It should make no difference at the end of the day, right? A real estate activity is not active business income. All right. It is considered to be investment income. Rents, royalties, dividends, interest. These are all not business income. Therefore, you don't get the small business deduction, nor do you get a tax deferral by you getting the general rate, right? You are going to pay 50% tax in the corporation on all your business, all your rental profits, period. You may have some 3-tier structures or triangle structures where you have multiple corporations that bill each other, which I guess were popular before the integration of the provincial sales tax into the GST to make harmonized sales tax, or HST. Okay. I don't see them working. When I worked out the numbers, they don't work. To do these 3-tier corporate structures or management fees back and forth properly, there's a lot of documentation that has to be undergone. There's a lot of filings, a lot of legal work. It's simply not worth it. And you're going to charge yourself HST, but you won't get an input tax credit. So bye-bye to your 13% of HST. So understand that a corporation could have use, but saving on taxes year to year is not one of those uses in Canada. We don't live in the United States. You're going to read books like Rich Dad, Poor Dad, and the guys talking about corporations. That's a different country, different tax system, has nothing to do with us, okay? However, corporations are very good for estate planning. They can help us bypass probate, and they can help us implement an estate freeze. And there's a couple of structures by which they can do this with, all right? You can close the property on title inside of a corporation, but, inside of a corporation, corporation's on title, corporation owns and operates the property, and that will bypass probate because we can do something called a corporate will or a secondary will, and we can implement an estate freeze, which is a nifty technique that allows us to freeze the value of your assets in your 60s or 70s and pass the growth to the next generation. And this can be repeated generation after generation after generation, pretty much infinitely deferring tax, all right? The second simpler situation is we can close a property or transfer it to a corporation, and that corporation will immediately create a bare trust and hold the property in trust for you and your spouse. We cannot do an estate freeze on that, but we can do probate because the beneficial owner is you, not the corporation. Okay. I'm going to get to that question after I finish this situation with corporations because it's a multifaceted answer. Okay, so just there, I'm actually finished that. Okay, so I have a question. All right, Gino asks, if we build a property and sell the asset, is there a capital gains tax or business tax at the corporate rate? So if you build a property and you sell it, all right, and imagine you've never rented it out. Your purpose of this property was to buy the property and sell it. You are a builder. You're considered a builder for tax purposes. That is not a capital gain. That's going to be business tax. And if your company qualifies as a small business corporation, you're lucky. You get the small business deduction, which currently on the first $500,000 of annual profit is only 12.2%. Okay. So if you're purposely building a property to sell it, you're an active business. You're not an investor. Under rules and regulations surround, obviously you're an investor, but under tax law, you're not an investor. Okay. You are a business owner. What you must be cognizant of is the HST. And this is where everybody gets nipped in the butt. If you sell the property that you have built from scratch, or if you have done a substantial renovation, meaning that 90% or more of the livable space in the property has been renovated. Okay? If you've done one of those two things, you are a builder and you must charge the eventual person who buys the property HST, 13%. You need to register yourself for HST, claim the input tax credits as refunds for your build out, and then charge HST at the end on the full value of the property. Okay? Also, just so that you guys know, if you substantially renovate a property or build a new property and then set it up for rent, like a long-term lease, there's a deemed disposition of that property. We hear deemed disposition again. You have to self-assess the fair market value of that property and pay HST to the government, even though you haven't sold the property. You're deemed to have sold it to yourself. The reason being is they want you to be in the same position as if you bought that property off of a builder, because it's, according to them, unfair for you to build a property and stimulate the economy and provide people with housing. They want 13%. I don't write the rules, guys. I don't know why they.
So when I did that, I mean, I was obviously able to. I built it. We self-assessed, but we were able to, write off all the HST we spent to build the place.
Yep.
And then, the value of the property, came in a bit low. So, my HST hit
wasn't that bad.
Only a couple percent.
You're still out because the value of the land you have to charge the HST on, which is ridiculous.
Yep.
But you have to be cognizant. You have to pay attention to that. Okay, guys? Okay, so before we get to the next part, I want to recap kind of what we've gone over. We've gone over what estate planning is. It's the final process in your financial plan. It's important because you want to know what happens to your stuff when you die, and who gets to call the shots if you become incapacitated, right? The big problems you're going to face are equalization of your estate amongst your beneficiaries, liquidity, you need money to pay taxes or whatever, okay? And you got to worry about the tax bill in general. What is it going to be? You got to try to predict it, all right? Corporations are not so useful for saving tax day to day in most cases, unless of course you're self-employed. We have strategies to implement. However, they are excellent for estate plans, because corporations, unlike people, don't die. So we can have secondary wills to deal with the corporations. Mark asks, how is the HST if the rental property was built by myself, not corporation? Doesn't matter if you yourself build it in a partnership, a joint venture, a corporation, a trust, a limited partnership. Doesn't matter. It's all treated the same for HST purposes. You have to self-assess. Okay. So let's get on to the kind of areas that the CRA, we're finding that the CRA is attacking. And these are kind of things that we're looking out for, that all of my staff is looking out for on our clients. Motor vehicle expense. All right. So motor vehicle expense, why is it important? Motor vehicle expense is very confusing. And I'm going to be honest with you, most accountants do not truly understand the rules. They may have studied the rules when, 25 years ago when they were in university taking Tax 101, and then conveniently forgot them. There's a massive CRA interest in auditing motor vehicle expenses, either for rental properties, self-employed individuals, and small business corporations. Why? It's easy pickings for the CRA. Nobody does it right. Everybody screws it up. Okay? So I'm going to go over the rules. How do the rules work? The algorithm is very simple. It depends. Do you have one rental property or do you have two or more? Let's go to one. If you have one rental property, and I'm sorry guys, I'm going to do the thing that everybody's told not to do with PowerPoint. I'm going to actually read this to you. If you've got one rental property, you can deduct reasonable motor vehicle expenses if you meet all of the following conditions. And this is a very important concept in tax, okay? And that's why I highlighted reasonable. You need a definition of what reasonable is. And you must meet all three of these conditions. If you meet two of these conditions, not good enough. All three. So what are the three conditions? You receive income from only one property that is in the general area where you live. What's the general area? They conveniently do not freaking define that, okay? You got to guess. You personally do part or all of the necessary repairs and maintenance on the property. Personally, you personally. Part or all. Well, what defines part? They have no definition, okay? Of the necessary repairs and maintenance on the property. I didn't highlight necessary, but is gardening necessary? I don't know, right? And you have motor vehicle expenses to transport tools and materials to the rental property. So you got to at least have a hammer in your car, all right? So it's got to be a reasonable drive from where you live to the property. What does reasonable mean? I don't know, okay? Like general area. Is the GTA a general area? Probably. You've got to be working on the maintenance and repairs. Either helping out the contractor, maybe that they consider that. There's no guidance on this, okay? And you must have some tools in your auto to go there. You cannot deduct motor vehicle expenses you incur to collect rents. You cannot deduct motor vehicle expenses to go serve somebody if you want to kick them out. You cannot go to say, you can't say I'm driving around to make sure that everything's on the up and up. It's only if you do the repairs and maintenance, okay? It's very, very restrictive. Essentially, what we're telling our clients is don't even bother. If you have one property, don't even write off auto, okay? All right. Now let's say you got two or more rental properties. You get an additional allowance to collect rents, supervise repairs. Okay, so now you don't actually have to do any of the hammering. You can just stand there and watch and manage the properties. What does manage the properties mean? I don't know. They don't define that. Okay. But now collecting, I mean, nobody collects rents anymore. Nobody goes and picks up checks, but collecting rents when you have two properties, yeah, that's a business expense. But if you have one property, no, it doesn't make any sense, right? So this applies whether your rental properties are located in or outside the general area where you live. Your rental properties have to be located in at least two different sites away from your principal residence. AKA, if you have a legal duplex, you technically have two rental properties, but it's one site, okay? So motor vehicle expenses are super complicated and I've dumbed them down, but they're super complicated and they're super restrictive. For the most part, they're not really almost worth taking, to be honest with you. I've got multiple rental properties. For myself, I don't take auto expense. I just write it off on my business, okay? Does anybody have questions about motor vehicle expenses? Or it should be pretty clear. I've put it pretty clear. Okay. All right. So the other major points for this is if you are going to take motor vehicle expenses, get ready for an audit. It's higher than likely that it could happen in comparison to other areas of audit. All right, you got to keep all your receipts, you got to keep all your proofs of payments, and you must keep an auto log. I drove to Rona or Home Depot, back, did this, did that. They want a whole story, okay? And if you don't have that, they're just going to simply disallow. Okay, so now conversion of properties. Maybe some of you know this, maybe some of you don't know this, but moving out of your house your principal residence and converting it to a rental property, or getting rid of a tenant and moving into a rental property is considered a deemed disposition, aka you've immediately sold the property to yourself and you purchased it yourself, and that is taxable. It is a taxable disposition. So, converting your principal residence to an income producing property. It's a deemed disposition and a reacquisition. Of course, you can claim the principal residence exemption. And if you make an election under Section 45(2) of the Act with a letter to the CRA, you can actually extend the principal residence exemption for up to 4 years. Okay, so I'll get into the other part, but let's say you move out of your rental property because you're moving to wherever, some other place far away for a temporary job for 3 years. You don't want to just pay your mortgage, this, that, and the other. You want to actually get some sort of, get somebody in there for a 2 or 3 year period while you're gone and you're renting somewhere else. Okay. You can actually extend the principal residence exemption, even though you've converted that property into an income producing property. So for up to 4 years, but you cannot claim any CCA, not even $1 of CCA. You can late file the 45(2) election, and note that this does not go on your tax return. It's a physical letter that you have to write in a non-prescribed way to the CRA. Like, you literally write them a letter. You can late file it. The late filing penalty is $100 per month, up to $8,000 penalty, but you cannot do any retroactive tax planning, which to me means if you've taken CCA on the property, I don't think you can refile old tax returns, get rid of the CCA, which you're allowed to do if you want to, okay, and then make the late filed election. And this can even apply if you make a partial change. So I bet you guys didn't know that if you do a little reno on your house and you put a separate entrance and a separate kitchen in your basement and then rent it out to someone, that's a partial disposition of your principal residence. And the basement is technically not subject to the principal residence exemption anymore. And they're starting to look into this now, whereas they had a policy of not really bothering with that before. Okay. So any conversion, partial or otherwise, is considered a taxable disposition. And I think it was recently that the CRA allowed a 45(2) election on the basement or partial conversion because people complained. Okay, now more interesting.
Can you go back there, Fabio?
Yep.
So I have a question on this. So, I mean, I did this a few times for myself.
Yep.
But like I didn't do the disposition part. I always was under the impression that you deal with that whenever you sell the property, not like in that tax year.
Right. So okay. The 2090 or whatever filing, which came into play, I think 2016, 2017. Okay. When you sell it, you can make the allocation of the principal residence exemption for the years that you were living in it. But if you want to extend the PR exemption by 4 years, you have to make the 45(2) election.
Okay.
Okay.
That makes sense.
You get what I'm saying?
Yeah.
So if you see that the gain on that property is higher down the road, you may want to even late file a 45(2). Okay.
Yeah. Okay.
So let's go to the other beast, converting an income producing property to a principal residence. And once again, we have a deemed disposition that will immediately trigger a capital gain and recapture of CCA. Of course, we can avoid this with a 45(3) election letter, though. Okay. The problem here is if you've taken CCA, you cannot make this election. Okay. So this is another reason why you want to be careful about taking CCA on properties, right? If a lot of people will take CCA or depreciation on their properties because they don't want to pay tax immediately, but you may want to reconsider if you're considering moving into a particular property. Okay. So just be careful. All right. And that brings us to the end of the sort of technical things that I wanted to talk about. And Paul, you had a bunch of questions, but I'm sure somebody's going to have another question. And we can get into other topics a little bit as well if you want.
Yeah, everyone, go ahead. I mean, I could ask questions for days here, but I mean, it's about you guys. So unmute yourself or put it in the chat, and we can dive in because I'm sure someone's question is ruminating in 5 other people's heads. So don't be shy.
Yeah. Go ahead,
Yeah,
Matthew.
Matt.
Hey, sorry, I joined the call a little bit late, so maybe this was answered earlier. But in the event that you offload a property that you were partially living in, like for a term before it was a rental property, in that circumstance, what kind of documentation do you need to prove the value of the home at the time, for the capital gains tax?
Appraisal is the only thing that they accept.
You had to have an appraisal at the time, or how do you
Yeah,
get
but
one retroactively?
it's very easy to get a retroactive appraisal.
Okay, we can get a retroactive.
Like,
Yeah.
what kind of appraisal? Like a proper appraiser from an appraiser or a realtor's appraiser?
Yeah, they'll wipe their butt with a realtor's opinion. They want an appraisal like from a neutral valuator, right? Like when the bank, when you get
Yeah.
like that.
Okay, got it.
Okay.
I have a
Okay,
question from Alf. What is CCA? CCA is just the depreciation of your property value over time. You can't write off the purchase of your property, but you can depreciate it over time.
Gino, from a tax perspective, would you suggest building a property in a corporation personally,
Yeah.
aside from the limited liability protection?
It depends on what you want to do with the property. Okay, so anytime somebody is doing an infill or if they're building a property, obviously from the liability perspective, I'm going with a corporation all day long. Okay, from a tax perspective, it depends on what you're going to do with this property.
Gino's going to sell it.
If you're going to sell it and the intention is to sell it, I'm going to put it in a corporation because I'm going to try to claim it as business income, right? If you're selling the property within a 12-month period, remember we have the anti-flipping tax rules now. It's business income, okay? So yeah, I'm going to do that from a tax perspective. I'm going to do this in a corporation, 100%.
Yeah, that makes sense.
Okay.
All right. Anybody else?
Hey Fab, I'll ask
Reserve
one. I partially know the answer to this because you set it up for me, but maybe just for the folks out there, run through what the advantages of putting a property in a bear trust are.
So the advantages of putting you put a property into a corporation and then you have a bear trust. So the corporation owns the property and it's holding the property for you. There's a couple of different advantages to that. One, on a title search, they're going to find the corporation, right? So it's harder to find out who owns the property. That's number one. So more privacy. Number two, you can have a secondary will. So you're allowed to have two wills: your primary will, which deals with all your normal assets, and then a secondary will, which deals with the shares of a private corporation. All right. That secondary will, when you die, doesn't need to be handed to the courts. So nobody can go and search court records to find out the details of what you left and to whom. So that's a private will. And because it doesn't have to get handed to the courts, you don't have to pay probate. So, if you accumulate, let's say, 5, 10 rental properties, which a lot of people do over time, you could easily have, $5, $10 million of properties to probate. $10 million of properties probate, that's like 150 grand of probate tax for nothing, right? And it's also something that goes through the courts and is public knowledge. So you might want to have a corporate will instead. So you can't have a corporate will unless a corporation owns the properties, right? And if the corporation is on title, you're not on title, but you are the beneficial owner of the property, then it flows out through the secondary will. Mark asked, what about building in a corporation and selling it to yourself after? It's just extra legal and accounting fees for nothing. Sounds like
You're doing that anyways for the HST almost, right?
Yeah, but then you would actually have to change title and pay land transfer tax and legal fees again.
Yeah, that's crazy.
It's just not, doesn't sound like a good idea to me. Matthew, you raised your hand.
It must still be
Thank you.
raised from before.
Oh, okay.
Sorry. But actually, yeah, so is there a way, so for capital gains that you can defer or distribute over coming tax years, or no?
Unfortunately, with investment capital gains, no. The only capital gains deferral you can, there's two capital gains deferrals. If you do like a vendor take back, you can defer the gain up to 5 years, like 20% per year, or some mathematical formula like that. But nobody's doing a vendor take back, right? Everybody sells and says, give me the money. Or if you have a business asset. So this office that I'm in is a business asset. I'm using it as a business asset, not as a what do you call it? A rental property. Okay. Business assets actually can be deferred if you replace them with another similar business asset, but not rental properties, unfortunately. Amina, what do we got here? I bought a property for myself with a legal apartment already built, and I am renting it. Would it be charged capital gain on selling? It's possible, yeah. It's a like a legal duplex. If it's a legal duplex, it sounds like that portion could be subject to tax.
Especially if you were claiming it, then yeah.
If you're not using it yourself, then yeah, I think it would be subject to tax. I think that's a reasonable conclusion, that portion of the property.
Yeah, I think the broader message, I would want to leave everyone is it's good to know all this estate stuff, but if you do anything, I think you're selling yourself short. It's nice to tell stories about buying properties and making money and holding it for 5-10 years. And hey, I got a couple $1 million of net worth now. But you net worth, you have to put stuff in place and do the work to protect it and make sure that your family gets to enjoy it also, right? At that point.
Yeah, no, for sure. And the rules are not going to get less complex moving forward. They should be, but they're going to get more complicated because, now you got the big tax law firms downtown, I'm sure, are investing in their own proprietary AI, trying to figure out loopholes in the act. The government's trying to figure out the same loopholes with their own AI, and it's just going to be an arms race, right? Like the federal government that we have right now has closed a number of loopholes that we've been exploiting for years for high net worth individuals. But I'm sure somebody's going to find them again. You know what I mean? But it's never going to get easier, especially with properties, and especially in an environment where properties have gone up in value so much.
Mhm. Yeah, no comments on the government here. What else? Anybody else have questions? Well, Fab, why don't you tell everybody how they can reach you, and if they need more help with some of this estate stuff, how do they contact you?
So
What does
yeah,
that
the
look like?
best, the best thing, if you ever wanted to contact me, primarily I work on estate and financial planning. The best way to contact me, go to the website, campanellagroup.com, and you'll see on the top right-hand corner, there's like contact us or book a consultation or something along those lines. And you type, there's a very, very simple type form, and that'll go to our team, and then we'll line up a meeting.
Okay. So just so
Yep,
everybody knows,
campanellagroup.com.
you're willing to have like a one-on-one meeting with people, just
Yeah,
to
yeah,
kind
yeah.
of-
That they just need to type up, give me a little description of their situation, because sometimes people will describe their situation. I'm like, oh, I already know that this is not my specialty, but I'll know somebody who is specialized in that particular area. You know what I mean?
Okay. And I'll include the website in that
Yeah,
when I send out the recording to everybody.
yeah.
Okay, we got one last question here from Manny,
Oh, Manny asked a question. Yeah.
and then maybe this is a good question.
What if you
What if you
build?
build
Yeah.
in a corporation and keep it as a rental? Would that be considered passive income?
Yeah, that's
Uh,
that's passive income, and you have to pay HST on a self-assessment. But we can get you your input tax credits for the build out, plus we can get you the long-term rental credit. It's about $24,000. We can get that back as well.
Yeah, it's not as bad as you think, Manny, on the HST part when you self-assess, and then
Yeah, it's not as bad.
then
We just got to plan
treat
it.
it like a
Yeah.
passive income. You would add it into your budget, make sure it's
Yeah.
accounted for. I can help you with that.
Yeah. And we would, it's very simple, Manny. I think I actually discussed this via emails, but you register for HST and you claim your input tax credits as you build out. Okay. So you're getting the money back.
Mhm.
Then when you self-assess, we can, and put in a tenant, we can get you another 24 grand back.
Yeah. Okay.
And that's regardless of whether it's in a corporation or not, right? But anytime you build, you definitely want to do it in a corporation from a liability perspective, because one non-WSIB guy comes on site that you wanted to get a deal on and they get hurt. Now everybody's suing.
Yeah, we don't want that.
No.
Okay. Well, if nobody has any, then we'll say thank you to Fabio. Wish him luck in the 2024 tax season, and we'll send out the recording to everyone and send out Fabio's contact. So if you don't have this stuff set up, highly recommend you guys. I have it in pieces, so I'm behind the 8 ball too. I mean, and now I got to do these. This guy just messed with my mind with this. He's going back in time and with all these properties that I bought as rental properties, then moved in, and vice versa. So I'm going to be dreaming about that tonight.
All right, guys, I hope you got something out of this.
And
If you have any questions, you can follow up with us. I'll be happy to help. You can send Josh, Paul, or myself a question, and I'll try to get back to you.
Okay. Take care, everyone. Have a good night.
Thank you.
Thanks, Ab.
Bye,
Ciao,
guys.
ciao.
Thanks. are definitely better than